Oh,
yeah, you're right.
What, a 5-hour energy thing? Of course, that'll keep you up till midnight. Just what you need. Okay, so he needs the energy to go pump iron.
Yeah, I'm gonna go hit the gym after this. But usually it'll be
I
fine.
admire anybody that can work out at any other time of the day other than first thing in the morning.
I know
I can't work out for
I know a lot of people. I've had this argument a million times because
I mean, we all have to do our own thing.
Biorhythm.
For like Edward, it's the middle of the day. For me, it's actually 4 o'clock would be like perfect if I felt that I
Yeah,
was
me too.
comfortable, like, leaving the office every day at like 3 or something.
2 days with triathlon for a
Oh,
while,
yeah.
but then I was like, yes.
That's okay if you're not working.
What do you got for us
That's the
today?
thing. It's like, yeah, I was eating into work a lot. I have most.
You have a theme? You have an idea what you want to talk about?
I have a theme, but it's not the most exciting one. It's just, I have that whole San Francisco home value soared $131 billion in 2015. I have the average American household owes this much on its mortgage.
Okay.
What was it? The Zestimate of the United States kind of thing.
I didn't see any of that. I didn't have time to hit the blogs today.
Okay, and then I have low inventories continue to bedevil the housing market, and then I have 1/3 of deals face closing delays.
And the Murdoch J this morning had the usual dumbass, home prices soar thing, and it's like, oh, median price $1 million. Well, like a year ago, it hit $1 million, and it goes down, and then it goes up, and then it goes down, and it's so, based on 14 transactions.
Yeah.
So-
Exactly. You can position the data however you want.
So the question we have for you, Mark, is how often do your short-term loans pay off before actual maturity? And then Rob, I'm self-employed and would like to get pre-approved to buy a home. Is it too soon to use my 2015 income to qualify? You guys ready?
Which
I don't know, what do we want to start with? You're the guest co-host.
Black one.
Rob, why don't you jump right in and whatever you kind of want to lead off with, and I'll chime in.
Okay, cool.
I've been collecting over the last several weeks just kind of the predictions for the year.
1, 2, 3. Yep.
We can hit stock market a little bit, mortgage rates. It's been a month since the Fed raised rates.
Rates is a
Mortgage
great
rates are
topic
basically
this
the
time.
same, so
With the stock market being the way it is.
That's a really good oil prices.
oil prices going below 30, and what is that? And that spooked the stock market.
You guys ready?
Yeah.
Okay, here we go. Welcome. You're listening to The Best of Investing on Talk 910. I'm your host, Edward Brown. I'm proud to have as my co-host Mark Hanf of Pacific Private Money, one of California's fastest growing mortgage investment firms, and Rob Spinoza of RVM Mortgage. Our phone number is 888-912-1190. Use that number to answer the trivia questions for 3 vacations given away during this show. And the vacations are not sponsored by the radio station, but by Lighthouse Resort and Marina, located 1 hour northeast of San Francisco. Check them out at lighthouseresortandmarina.com. And the vacations are free. Their only request, a $75 cleaning fee to cover the housekeeping expenses. Today's trivia theme is miscellaneous trivia. Get
that narrows it down.
Yeah, just a little bit.
Anything that pops into your head.
Yeah.
Wrong answer. Imagine that.
Yeah. All right. So, Rob, with the stock market the way it is, what's going on with mortgages?
I am not to blame for the stock
Yeah.
market. I want to go on record and
Crazy
get that up.
week.
It's been a crazy week. It's been a crazy start to the year. And there's a lot of market forces at play that we see. Now, what's interesting about what I see happening in the stock market, and especially the mortgage market right now, is how different the tone is this week than it was maybe the last week of December. It is literally night and day. Last week of December.
What do you mean by that?
Last week in December, we were fresh on the heels of the Fed raising rates
Yes.
at the 18th or 17th,
Yeah.
and the tone was very bearish with mortgage rates. Everybody was looking at 16, saying what's going to happen.
Yeah.
We know they're going up now, and here you go. You start off 16 with an incredible downward run on the stock market, and we've had this nice rally in mortgage rates. People are talking refi, booming in again.
Right, so we're back again this week in right around 4%, right?
Under on a lot of programs,
Under
and
4%.
the bigger the loan. Thanks guys, Dodd-Frank. Thank you guys. Bigger the loan, the better the pricing.
Wow.
Helping
that's-
helping the little guy, right?
Well, that's great to know. So
Yeah.
a month after the Fed makes their first rate increase, on the short-term side, again, remember that
Right.
the Fed controls short-term interest rates, not long-term interest rates, which are really the source of how mortgages are priced. And now, a month later, mortgages are basically right where they were at 2 months ago.
Yeah, and what you've got going on here in the market that I see is going into the end of the year, everybody, all economic eyes were looking at the jobs reports because they wanted to see that the economy had gained enough momentum in employment that the Fed could begin to lift rates off, and that happened. So job creation was stable and strong and robust through the end of the year, and lo and behold, the Fed raises rates. But they have a dual mandate, and the other piece of that is inflation and price power. And there's none of it. And the move in oil is highly deflationary. And now I think you've got a lot of people looking at the financial market saying the Fed has no more room to continue to raise this year. And I think the market is rallying off. I mean, the bond market is rallying off of that.
Yeah. Well, that would surprise me a little bit if we didn't see a continued steady, 0.25% raise here and a 0.25% raise there, just as a just to placate those.
The Fed's in a tough spot.
Yeah, they're in a tough spot. I mean, there are those with some loud voices that are in the that are experts in the economy, and when it comes to the money supply, and there's just been a lot of fears about how large the money supply has grown thanks to near zero interest rates.
And seniors. Seniors are upset because their CD rates.
And there's no savings, so
yeah.
notwithstanding the money supply, there's no savings, and money is too cheap, and it encourages a credit bubble, and and all these factors that would make sense for maybe not a huge increase, and maybe not even to where we may have been in the 1990s or early 2000s, but at least to get that prime rate back up in somewhere in the fives or even sixes. So there's just a lot of support for that, but.
I think they've got their hands tied. I think that
and if you do it,
they're very much in that predicament. And
gosh, 7 years where we were since they lowered the rate to the point they did, and then we had no rate increases during that whole time.
I think what it also brings to light is everybody that bought a home in a lot of the years 2013, 2014, 2015 now. And it's always a good, I think, we're here on Best of Investing, but it's always a good time of year to revisit things, looking at your finances and saying, okay, well, I bought this house in 14 or 15 and my rate is this. These opportunities come up. They do from time to time, and it's worth knowing what you're paying on your loan, what kind of a loan you have. I mean, a lot of people are still going to face home equity line of credit resets this year. 2016 is a big year. It's 10 years after 2006, which I think was the peak year for getting a home equity line of credit.
Yeah, that's right.
And prime rate, like you said, Mark, Fed raised rates, so that actually went up, and that's not going to go back down.
Yeah.
So if you have a home equity line of credit and you are going to confront that conversion in 2016, what's going to happen is you're going to end up with a fully amortized loan over 20 years, most likely, at the margin that you have on that line of credit plus prime rate, which is 0.25% higher, thanks to the Fed.
Yeah. Well, getting back to what's happened in the stock market this past week, and in fact this entire year, it's amazing, what's happening in such a relatively short period of time. We've just had this big shock to the market, and I was interested to read a Wall Street Journal article at the beginning of last week that interviewed over a dozen Wall Street investment firms, and they are very much have all pulled back their predictions for where the
just based on the first week.
Right, where the S&P and the Dow is likely to be.
Wow.
This time next year, and for the most part, many of them are predicting it's going to be at or near where it is right now.
Well, it's got to go up 10% just to break even from where it's been. December
Right, as the first week.
Right. So the point being, they're expecting the market to underperform, and it's interesting because I recall an article in Bloomberg, the Bloomberg Weekly Business Report from July that predicted that, and at the time in the summer, the market was it had a few seesaw events back then too, but largely at that time it was still ahead for 2015, and I thought, wow, that's an interesting bearish prediction in a major periodical to be saying, the market is, or that particular author expected the market to underperform in 2016 and beyond. And now here we are in 2016, and many of his peers are starting to predict the same thing. So, what's an investor to do?
Here's what I find interesting about stock market analysis over time, right? So you look at 1 week in 2016 and the effect that that's had on people in any number of ways. We look at it from a housing perspective, but use whatever viewpoint you want. Now step back to 1930 or 1940. Information just didn't move as fast as it does today. And how many people were in the markets back then? You know what I mean? Like how many of your ordinary folk had money in the stock market? Small percentage. So you take all these numbers and you compare them to the historical averages of the Dow and the S&P and all that kind of stuff. And I make a point that, you know, things just move faster now. And what happens in 1 week in 2016 is like the event that would have happened over the course of a year in 1955. You know, and it's just, but yet we use all the data to say, well, every 75 years something like this happens. It's like, yeah, but it ain't the same 75 years in my book. It's kind of like information just moves.
Well, we got to bring back the Pony Express. All right. Before we cut to our first commercial break, I want to make a quick mention here. There's going to be a Neil Diamond tribute at the Lesher Theater in Walnut Creek, and the tickets are very reasonably priced, and the venue is really pretty. So check out the Lesher Theater in Walnut Creek. There's going to be a Neil Diamond tribute.
Super Diamond? Is it the band Super Diamond?
No,
okay.
no. It's this guy. I can't remember his name, but it's one guy doing it, and that's on February 5th. And then Old Blue Eyes, a Frank Sinatra tribute, is on February 6th.
We are bringing back the Pony Express.
That's right. Yeah. So check that out. Take a look at Lesher Theater, Walnut Creek. They have some other stuff coming up, like Pink Floyd and Led Zeppelin and all that stuff we'll talk about in the next few weeks. But anyway, check them out. Okay, so now we're going to cut to our commercial break here. And again, it's miscellaneous trivia. There are more collect calls made on one day more than any other day of the year. Which day? All right? Stay with us because you're listening to the Best of Investing. When we come back, we've got some very interesting emails for our co-hosts. Stay with us. Don't touch that dial. All right.
Mother's Day?
I'm going to say, I was going to think Mother's Day too.
No, call your mom, collect.
That's right, collect calls. That's what what day
That's a
of
good
the
jump
year?
to my mind, though.
People still call.
When was the last time you placed a collect call?
I didn't even know you could.
Yeah,
Can you still
I
hit
don't know how to
zero
do
and get
it.
an operator?
Who has a
It's like,
payphone?
Who has a landline?
Tin cans and a string. Pull on the string.
Hey, you might have to explain to the audience what a collect call is.
Yeah, really.
Back in the old days, they had payphones.
While we're on the ancient history.
Yeah, exactly. Back on the Pony Express.
Mother's Day, Father's Day, Valentine's Day.
It's got to be Mother's Day.
Okay, guys ready?
Yep.
All right, here we go. Welcome back to the Best of Investing. I'm Edward Brown, your host, along with Mark Hogg and Rob Spinoza. When we cut to the first commercial break, we asked this trivia question. There are more collect calls made on one day more than any other day of the year. Which day?
Well, the collect calls was throwing Rob and I because we were both thinking it's Mother's Day, but then it's, of course, it's like collect calls. You know, where'd you find this question? Does anybody even remember what a collect call is?
Is that when a debt collector calls you and that's a collect
Yeah.
It's like from a payphone, which don't
Yeah.
even exist hardly anymore today.
Ready?
Yeah.
Yep.
Father's Day.
Oh!
Because they wouldn't dare do that to the mother.
How many fathers take the call, though? I mean,
That's
come on.
Yeah, okay, finally. What do you want, money?
Yeah, right.
All right, so Mark, we received an email from a listener who says, how often do your short-term loans pay off before the actual maturity? So this is somebody who's heard you before on the radio, obviously, and realizes you make short-term loans.
So my company is Pacific Private Money. We're based here in the Bay Area, and we make privately funded real estate loans, private money loans. Some people used to call them hard money loans, but we're we make loans to real estate investors and people who need short-term bridge loans and other situations where people need fast funding, a fast funding alternative. Companies like Pacific Private Money are kind of a Plan B option when Plan A fails, Plan A is always to borrow from the banks because you can still get bank money at 4%, like we were talking about in the last segment. And hard money or private money loans typically cost anywhere from 8 to 10%. We do a lot of loans between 9 and 10%. That's kind of our typical rate, and it's it costs that much because private parties fund it, and there's a sense a little bit of sense of risk of funding that type of loan. But generally the loans are paid back pretty quick. So we're not usually making 30-year loans at 10%. We're usually making 6-month or 12-month loans at 10%. We want people to pay us back quickly. That's kind of our business model. We charge fees for the money and an interest rate that will compel them to pay that loan back as quickly as they can. That's kind of how it works in the private money lending realm. And so we generally at Pacific will write a loan for maybe 6 to 12 months. We don't normally find out, well, how long do you need the money, and I'll pay you back in 4 months, and write them a 4-month loan. It's usually a 6 or a 12 or an 18 or 24-month term. We tend to round up. But many of our loans don't have prepayment penalties. So, in fact, one of our most popular loans is our 11-month bridge loan, which is intended to help people buy a home and they can't get bank financing for this particular transaction. Maybe it's speed, maybe it's because they're buying a home they want to move into, but they don't quite make enough money to have 2 mortgages at the same time. So we help them buy that target home. And there's a regulation that allows us to make a loan with interest-only payments and a balloon payment for that situation under the new Dodd-Frank regulations, and we have to make that loan with a term in under a year, and so that's why we make it 11 months. But
Got it.
so we make these 11-month bridge loans, and they could pay back in 6 months or 6 weeks or 9 months. I would say probably more than 50% of the loans we write are paid off before the maturity date. In fact,
Well, they better, or else you're going to file a notice of default.
well, not necessarily, because a lot of our loans, maybe we make an 11-month bridge loan and they haven't been able to refinance. Something unexpected happened in the process, and we extend them. We don't necessarily, file notice of default or have it go into foreclosure just because the loan matures. In fact, we have a steady stream of maturity dates that come, and we negotiate with the borrower. How much
Right.
more time do you need? And we decide on what fee we want to charge for that extension. Usually it's less than the original fee because they're already a borrower. We already have the paperwork. The paperwork's less.
Yeah, how
But it's a
often-
smaller percentage. I would say how often that happens. Maybe 20%
Okay.
of the loans we make. Maybe it's less than that. Maybe 15% actually reach maturity, and now we need to have a discussion about, okay, so what's going on? What's happening? How much more time do you need?
Right.
Can we help? So
Yeah.
what's the situation?
Well, how often does somebody come to you who knows that they already have a loan from you,
Yeah.
and it's a 2-year loan, and they're into it for 18 months, and they realize, in the next 6 months, I know that I'm going to need to extend. How often do they come to you many months ahead of time rather than
11 down.
3 weeks? Yeah.
Well, our software system will send out within 90 days of maturity a maturity notice.
Gotcha.
So that
Not
not quite 6 months in advance, because we don't want to start hammering them too early. But we make an 11-month loan, and after 5 months, we're giving a 6-month notice of maturity. That would be a little bit too much. But we do a 90-day, and so that will normally start the conversation. It'll be either email or phone call saying, hey, I just got your email, and oh yeah, that's right, my loan's maturing. I'm going to need a few extra months. Because again, oftentimes we've made these loans where there was a situation where they believed they'd be able to either sell the property or refinance the property as their exit out of our loan. And so we then go back and revisit what was the original plan that you had to repay the loan and what's happening, and again, how can we
Right.
help? So
And then you charge points or fees.
generally we charge an extension fee, right?
Gotcha.
If the loan was maybe 3 points initially, we might go 1.5 on the extension, maybe 50% of the original fee.
And
It's not
extend it
unusual.
for how long?
Depends, circumstances
Yeah,
depending.
6 months to a year. And there's another factor of it. If this was funded by our mortgage pool fund that we control as the broker, we have flexibility in deciding for ourselves how much we feel comfortable extending that loan. If it's a private party, because we also work with high net worth private individuals who like to fund individual notes, then we have to contact them and decide, Are they, enjoying the rate and the prompt payment every month, and would they like to offer an extension, or would they rather get paid off and have that money sit in the money market account getting 0% return
Now,
instead of the 8 or 8.5 or maybe even 9% that they're yielding off that note?
I get the idea behind the 11 month and the regulation that swirls around that.
Yeah.
If you extend the loan beyond that, you're still okay compliance wise because your intent was the 11 month, correct?
We are, but there is the details of that are on the 11-month bridge loans. We actually we can extend the loan as long as we don't change the rate or actually charge another origination fee. We can
Okay.
charge a loan modification fee, but we can't actually
Got it.
charge additional points. So there's a little bit of a nuance there on that particular loan. On other loans, if it's not a consumer loan, then
Right,
then
right.
we can in fact we can renegotiate and charge full points if we chose to, and we
Right.
might depending on the situation.
Sure,
So it's
sure.
going to be case by case. So anyway, I hope that answered.
Yeah,
Answers
that's-
question.
very
that's
clear.
insightful,
Very
yeah.
clear. Okay, Rob, email came in for you. It says, I am self-employed and would like to get pre-approved to buy a home. Is it too soon to use my 2015 income to
Oh, that's a great question. So the thing I want to say first is if you're self-employed and you're looking for a home loan, don't be discouraged, because I think a lot of people just think I'm self-employed, I'll never get a home loan. Nothing could be further from the truth. We make great rate residential mortgages with all the drill of going through the process to self-employed individuals all the time. So that's the first thing. Second thing is, what you're going to start dealing with now at this time of year. You're self-employed. Let's say we'll take the simplest version of self-employment, and that's a sole proprietorship. So you're going to file your 2015 tax return at some point between now, likely in April 15th. And the income that you claim on that return will be the income that we'll want to use to support your earning trend for 15. When we look at your 13, so we'll still be looking at your 13 and your 14 right now because you haven't filed your 15. But in addition to your 13 and 14, we will have an idea from your profit and loss statement of how the business did in 2015. So the general advice here is, if you're self-employed, you want to get your returns filed because that's how we're qualifying your income. If you're a salaried individual, you get a pay stub, you get a W-2. Your W-2 kind of signifies what happened during the year. But as a self-employed individual, you may not be getting that. So getting your returns filed is critical to using your 2015 income. The other thing that I would suggest is you get that information in front of a loan officer as soon as you can, because we're going to look at the trend. And it's very important when you're self-employed that you're showing an increasing trend in your income. One of the things that the lending industry doesn't like to see is, hey, I earned more in the previous year than I'm earning now, because then an underwriter wants to go down the path of, well, is this decline going to continue? And if it did, what do I need to consider with your debt to income?
Well, yeah, if a guy makes $1 million a year and somebody makes $800,000 a year,
Right.
it doesn't look good.
It does.
But you can still make a loan
Of
for
course.
$200,000.
You of course, but believe it or not, those are the kind of situations that are tricky because lenders have a very narrow box in which to operate, and they have to prove ability to repay the loan. So in your example there, we may want an additional year of tax returns. I've had that happen before where they'll say, okay, well, give me 2012 and let's see how that looked.
And also, I guess the percentage of decline is important.
Absolutely. The percentage of decline is another component of that. So these are all things we look at, and that's why I wanted to preface the whole thing with saying, look, if you're self-employed, certainly try. If you had a good 15, then that's a great start. We can counsel you on what to do to get prepared to use that, so you can use it in your pre-approval. And I'll also tell you this. There are a lot of great programs out there right now, some even Fannie Mae, Freddie Mac backed, that'll allow 1 year of tax returns for a self-employed individual. So if your best year was 15, you get that on the books, you can qualify off of that, and that might be a lot more than if we had an average 14.
Very good. How do people get a hold of you?
They can find my bio on the Best of Investing website, and I work for RPM Mortgage. I'm out of the Mill Valley office, and my phone number is 415-367-595. You can Google me too, and I'll come up on Yelp and all those great places.
Oh, good.
Yeah.
Okay. And Mark, we forgot to ask for your information.
Sure. My name is Mark Hanf. Company is Pacific Private Money, which can be found at pacificprivatemoney.com, or call 415-883-2150.
All right, we're going to cut to our second commercial break. Before we do, the Meritage. You deserve it. A luxurious getaway in Napa Valley. Meritage Resort and Spa boasts world-class luxury. Stroll across acres of hillside vineyards. Enjoy award-winning cuisine. Relax in the estate cave as you pamper yourself with a spa terra or savor flights of Trinitas Cellars wine. Isn't that great? Meet your friends in Crush Ultra Lounge with 6 bowling lanes.
How much is a flight of wine?
I don't know.
Okay.
That's pretty cool. So make reservations now for special winemaker dinners, the holidays, which are just passed, and Masters and Makers at Meritage. And you can visit them at meritageresort.com for details. Go on their website. Very, very pretty place. Gotta say. Okay, here is our second commercial break trivia question. Which country has the largest KFC restaurant? All right. The first caller with the correct answer wins a free 3-day 2-night stay at the Lighthouse Resort. Call 888-912-1190 to answer that question. What country is this? Wild trivia.
That's great
here.
stuff.
Great stuff.
Yeah.
What country has the largest
Colonel
KFC?
Sanders would be proud.
He would be. All right. Stay with us. You're listening to the best of investing.
Got it. I would say China, but I'm going to say Mexico.
Ooh, Mexico, China. Maybe I'll just say Germany.
Oh, so, okay, you remember John Douglas?
Yes.
Okay. So we have, he was trying to sell those 2 properties and hasn't had so much success. So we got him in touch with another broker who, when we were talking, blah, 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 you know him, Gary Gustafson.
Oh, sure.
And I thought that was kind of interesting. He goes, yeah, I know Mark, because I know his dad.
Doesn't he work with? Isn't he also with Bradley now in their commercial division? Or?
No, SVN.
Okay, SVN. Yeah.
I'd ask you for deal of the week. You have a deal of the week?
I would rather talk about the event and the fund performance for
Oh, yeah.
2015,
Okay.
and that might be better because we talked a little bit about lending already, or borrowing rather,
Gotcha.
with that question.
Okay.
So I have a deal
Fair enough.
because I'm kind of again I'm a little bit mentally loopy, but I can go on autopilot and talk about the fund. But if you ask me to think about a deal, there's just been it's
Well,
been a
said
little
that, we had this event last
bit,
night.
little bit lean, and Rob, you got some more articles.
Yeah, I got some
there.
stuff. Yeah.
Okay.
Okay.
All right, you guys ready?
This is just
Sure.
3rd out of 4, right? So we're
Yeah.
not, so we've got 2 more segments.
Yeah. Well, welcome back to the Best of Investing. I'm Edward Brown, your host, along with Mark Comp and Rob Spinoza. Second trivia question. What country has the largest KFC restaurant?
Mexico.
Germany. China.
China.
That was the easy one.
That seemed like too easy an answer, so we figured
Yeah, it
you
went
with your
further
trick
afield.
questions wouldn't
Trying to be tricky here. Okay, so Mark, on Wednesday night we had a very successful event. We prompted it here on the or promoted it here on the show.
That's right.
Tell
Best
us
of
about it.
Investor listeners will recall that we were having our first 2016 fund event, an event to showcase the Pacific Private Money Fund, which we've talked about on this show for the last 3 years since the fund has been in existence. I'm going to throw out some numbers, but before I do, I just want to mention to the audience that past performance is not a promise of future results, and you must qualify before being able to make an investment in the Pacific Private Money Fund. But we were able to showcase the fund. We had the year-end results for 2015. And of course, we all know what's happening in the stock market right now, and the stock market's down.
Yeah, how about that?
And
That's a different
most
light on that.
most people have exposure to the stock market. Let's face it, if you have a 401k or any kind of retirement plan that doesn't allow you to self-direct in terms of being able to invest in alternative types of investments, then that most of the choices you get are all mutual funds or stocks, or maybe even the company you work for's own stock. And so many of you are kind of stuck and unable to really consider in your retirement plans the type of investment that we're going to talk about here, which is also known as a mortgage pool fund. And we call it an alternative type of investment because it's not one that's traded publicly. It's not readily liquid like a stock or a bond is that you can buy and sell through your broker or online. But the nature of these types of investments is oftentimes you can earn significantly high yields. And the Pacific Private Money Fund for 2015 produced a distributed yield to our shareholders of 8.2%.
Wow.
And since most mortgage pool funds, you can be an income investor or a growth investor, meaning you can take the monthly distributions that are paid out, or you can let those earnings buy additional shares. So for a compounded yield, so our compounded yield for 2015 was 8.54. And since the fund's inception 2.5 years ago, we have produced an 8.2 return, the same return that we produced in 2015, the calendar year 2015. So 8.2%, and that was pretty much when we created the fund, started creating the fund a little over 4 years ago, and finally launched it 3.5 years ago. The goal was to have a fund that would produce yields between 8 and 9%, the target being right around 8.5%. We've met that, and we produce that yield through the fund by making loans, real estate secured loans with that fund capital. And these loans are identical to the loans that we also make using high net worth individuals who fund those loans directly. So Pacific Private Money, we have two types of investment options for our investors. One is you can be a note investor where your name is on the note and the deed of trust, or you could be a fund investor where you can just write a check to the fund and we, the fund managers, make the investment decisions with that. There's a lot of differences and a lot of pros and cons between those two, and that's what the event was about Wednesday night. And we had close to 100 people show up. It was extremely well attended. We
That's fun.
filmed the event, so there'll be a link available on our website or one that we can send you via email. There's also a PDF of the slide deck, which is available at request. So for more information about how you can earn 8.2% currently paid out on your invested funds, please visit our fund's website. There's a separate website for the fund. It's called pacificmoneyfund.com. That's pacificmoneyfund.com. Or just call us, and there's several people in our office, any one of which can chat in great detail about how the fund works, why the fund works, and why you should consider investing your hard-earned savings into an investment such as the Pacific Private Money Fund. So our phone number again, 415-883-2150, and we're located in downtown Novato in Marin County.
And I was his sidekick that night, so I'm hoping that the film will knock 20 pounds off me via Photoshop or however they do that.
We had a lot of fun. We started the show with the intro. We used the same William Tell overture intro that we used for the show and played it off like we were doing a live performance of the show. So
Mark had to tell people.
The audience got a kick out of it. So it was a lot of fun. So again, if you'd like to see a replay of that, please shoot us an email. Go to the website and our email contacts and phone numbers, everything there. We have a very transparent website. We provide all our contact information, name, address, phone number, everything is all there.
Rob, you've got a couple of interesting articles to share with us.
Yeah, I thought that it would be fun to talk about, not to harp on the whole start of the year and all that, but one of the things we're noticing here, beginning 2016, there's not a whole lot of homes for sale out there, and that's really sort of plaguing the market because you've got a lot of buyer demand, a lot of interest, but just not a lot of homes to go and look at. So I thought we could talk about that a little bit because that's an interesting dynamic that holds over from the seller psychology going into the holidays. And here I know in Northern California, probably less so in Southern California, you also have that weather thing. People don't want to show their houses when it's raining and risk low traffic on their open houses and potentially not getting the kind of interest they would have otherwise gotten if the weather were nicer. But what we're seeing here in Marin is, I think the stat I saw was less than 1 month of inventory out there. And you just have people clamoring for anything that's decent.
Well, in the East Bay, we make a lot of loans in the East Bay, and so I have a lot of relationships with East Bay realtors, and they've been telling me the same thing, just ridiculously low inventory. So what that's saying is that there's buyer demand out there right now. They're not waiting for after Super Bowl Sunday, which was kind of the unofficial start.
Okay,
of,
game's over. Let's go buy a
Right,
house.
the Sunday after Super Bowl. Yeah.
Well, the reason's probably because
For open houses.
they figured, you know what, let's do it before everyone else.
Yeah.
Yeah,
Because
yeah,
otherwise they get locked out.
Yeah.
So there's demand right now, and it's funny because for the better part of the past year, we've been wondering, when's the market slow down? When is this all going to kind of pull back? When is price appreciation going to slow down?
Right.
Well, I just pulled the latest Case-Shiller index, which I follow pretty closely again, and of course it's a couple of months behind. They have the numbers for November. And it's still year over year 10% price appreciation. We've had price appreciation at 10%, holding steady at 10% for going on 2 years now in the San Francisco Bay Area. So that doesn't look like it's going to abate soon. And one of the reasons is just as you said, Rob, is lack of inventory creates demand. It fuels price bidding. Price increases.
Well, this article in National Mortgage News is also interesting, and it kind of plays right into your wheelhouse too, Mark, because it says here, there are many reasons cited for slow recovery of single-family housing market and low number of home sales, including tight credit, underwater homeowners, and those who want to stay in their houses for longer than usual. That all sounds like yesterday's news, and that's not kind of what interests me. But what this guy's talking about here is one factor usually overlooked is the supply of single-family homes that are locked up as rentals. There are 90 million single-family homes in the U.S., and the stock of rentals for such houses jumped 33% to 12 million in 2013 from 9 million in 2006. And so I think what people are finding is you also have an environment where rent appreciation is very robust. So if you're a landlord, it's a good time to be a landlord, in other words, and that's further capping the amount of homes that would otherwise hit the market. Because if you're a rental, if you can take a renter out, put a new renter in at a better rate, why are you going to list that home for sale? Or, if you list it for sale, you have the tax advantage of 1031ing it into another rental. So, it's being bought by another investor. So this article is focused on that, and I think, it's hard to really see that day in and day out when you're, especially in my position, you don't see that kind of stuff, but at the end of the day, it shows up in the inventory numbers.
Very good. Tell you what, guys, we're going to cut to a last commercial break here. And let's see, before we get to our trivia question, we got another mention here for the beautiful Monarch Cove Inn. So if you're looking for an idyllic weekend getaway or unforgettable spot to celebrate life's happiest occasions, the breathtaking Monarch Cove Inn stands on a 100-foot cliff overlooking Monterey Bay. That's got to be beautiful. 180-degree span view. I can only imagine. Monarch Cove Inn has 9 rooms in an alluring Victorian house, as well as 2 cheerful standalone cottages. Each room has its own private amenities. You get breakfast brought to you your room each morning. Now that's got to be romantic. Secluded on a quiet road, the Monarch Cove Inn is a relaxing few minutes walk to charming Capitola Village. Check it out at www.monarchcoveinn.com. All right, we are going to cut to our last trivia question, and here it is. General trivia is the theme.
Got it.
Which notable structure is 6 inches taller in summer than it is in winter? All right. And if you don't get that, when we come back, maybe I'll give you a hint, but not now.
Okay.
No hints. Stay with us. You're listening to the best of investing. Okay. All right. Let me
6 inches taller in summer than it is in winter.
So it expands.
Yeah.
So it's
6 inches though.
But it could be Empire State Building or Statue of Liberty.
I bet it's a Statue of Liberty 'cause it's all bronze. Or copper, right? Isn't it copper? I have no idea.
It's not wood.
It could be the Golden Gate.
It's
But
green cheese.
keeping you in suspenders here.
yeah.
Keeping you in suspenders. Okay, we got 13 minutes.
Oh boy.
So we got good time.
So I think we should go into this, Mark. I think we should, because I think this actually has some substance to it. The other stuff is all just stats.
Yeah.
But these are kind of cool. I mean,
Okay.
Yeah, let's go. Let's talk about that. That's good.
Away we go. Welcome back to The Best of Investing. I'm Edward Brown, your host, along with Mark Hoff and Rob Spinoza. Last trivia question. Which notable structure is 6 inches taller in summer than it is in winter?
Where's the hint?
Okay.
So we talked about the Statue of Liberty.
Okay.
We're gonna go with
Okay,
that.
okay, that's not right. It is because the expansion of steel.
Golden Gate Bridge.
Okay. It's a
Empire State Building?
worldwide structure.
It's a worldwide structure.
Dubai, whatever that building in Dubai
No,
is.
you've heard this before.
Petronas Towers. I don't know.
I've never heard of that.
No, it's a one of the tallest buildings.
Get close. The Eiffel Tower.
Oh, okay.
Come on, guys. That's okay.
My daughter would have guessed that. Paris is your favorite city.
Paris is a great town. Vive la
Of
France.
course, I don't want to be standing on it when it's 6 inches taller. It's too high already. Okay. Rob, you got another interesting tidbit for us.
I have another interesting tidbit. It hits close to home because it deals with closing delays, and this is something that has bedeviled the mortgage industry now since the Telerespa integrated disclosures went into effect on October 3rd. We really started to bear the brunt of that in December. For those of you who are not familiar with this, good for you. Number one.
You don't want to know.
And secondly, part of the Dodd-Frank Wall Street financial regulation.
Reform Act.
Yeah, Reform Act revised the closing documents that
Yes.
you'll see when you next go to close a residential mortgage transaction. And what it did is it imposed some timelines and some other things that you can't get around, and everybody in the industry feared that this would delay closings. This article isn't really related to that, and I think it's refreshing to read one that is not. Now, TRID has certainly imposed challenges on our industry, no doubt about it, and going into
And don't forget, TRID stands for the reason I drink.
the reason I drink, that's right. Telerespa integrated disclosures. Edward has got a problem off air that gets on
Field intervention.
Yeah, it gets onto the air, but
I only drink to excess.
Days that end in Y. What we saw with TRID in December was it got compounded by the holidays. So you're dealing with these hard and fast timelines. You got the holidays, people are on vacation, all that kind of nonsense. But this is talking about Realtor Magazine. 3 biggest causes for a closing delay. 1 is buyer financing setbacks, so that could include TRID. 2 is home inspection issues, and 3 is appraisals that are different from the agreed upon contract and sales price. Okay.
Are they saying these are things that are happening now that weren't happening before?
No, I think it's all
Or
encompassing.
more.
Right. So I think TRID is included in this, and if we go back and look at the dates, we might be able to determine exactly
Got
how
it.
much of that. But it talks about some things that, you know what, putting TRID aside, the most common reasons for financing falling apart in the last minute are credit scores that change between loan approval and closing.
Yeah.
And, I don't know how much your side of the business sees this, Mark, but we see it all the time. People will do things during their close of escrow because if it goes 30, 45 days, life happens, right? So you go out and you finance something on a credit card or you do whatever, and then the lending process is so thorough now that it picks up all those things.
Yeah. So the survey does say that as of this past December,
Okay, so
average number of days to close has increased to 49
Yeah.
days from a year earlier, 42 days. So we're talking about an additional week.
yeah,
And
and as a
49
percentage
days,
of total days,
that's
that's a lot.
7 weeks. That's
Yeah.
just an amazing delay amount of time. And so if you are looking to use conventional financing to purchase a home and you come across one of these delay issues, I mean, how many escrows can you have in a tight market where
Right.
the seller has choices, particularly cash buyers?
Yeah.
Are they going to go with the guy that can close, within 30 days or maybe even less?
Yeah.
Because
These-
they're so well qualified,
Well,
or
what they do is they come to you for the all cash deal.
Move
to
around
speak,
it.
borrow-
That's right.
Borrow
So-
money for a specific
yeah.
amount of money and then go to Rob.
So looking at this, 49 days on average as of December of 2015 to close a residential mortgage, and no wonder private money lenders like Pacific Private Money are seeing an increase in phone calls from desperate realtors and mortgage brokers, believing they're going to lose a transaction. Now, mortgage brokers call me because they are going to lose the transaction, but they call me to refer their client because they want me to go ahead and close with a
Right.
private loan,
Right.
Yeah.
and then as they have more time to fix whatever
Takes the
glitch
pressure
is
off,
hold
right,
up, right? It takes
right.
the pressure off. Now that's more expensive for the borrower and the buyer borrower for that home,
You know,
but
it's really
they get the home.
to get the home, but also,
Yeah.
you know, if it's going to take, let's say, less than 6 months to fix the problem, the interest rate probably isn't.
Yeah,
the big
it's the
deal.
less
It's the
significant,
points
right,
that
Right,
they're
it's the
gonna pay.
fees, right?
Yeah.
It's so on a Marin County or
But-
San Francisco transaction, it could add $20,000 to the cost of the home. But if
Well,
you're
what,
paying,
what happens if you lose your earnest money deposit?
well,
Hey,
that
there you
that
go.
too,
So-
yeah.
so yeah.
5 or 50, yeah.
Right, oftentimes that's exactly it. We were talking about that at the presentation the other night.
Yeah.
We showed 4 examples of transactions that we've done in the last year, and one of them involved a $75,000 non-refundable
Yeah,
deposit.
So what happens, for the listeners out there, when you go into a contract, you're going to make an earnest money deposit at the beginning of the transaction, and then as the transaction goes forward and you cross certain deadlines, that money may become non-refundable. So if a problem reveals itself after you've crossed that deadline, you've got to find a solution, or you lose your deposit.
So Rob, Rob, you're a conventional
Yeah.
mortgage broker at RPM Mortgage, and so what do you do, and how do you work with your clients to try to avoid a 7-week escrow? Are there things you can do upfront in advance?
There are.
Working with your client.
There are.
What do they look like?
One of the conversations I have with folks up front is I try and get a sense of when was the last time they've been through the process. Because if it's 2005, they're in for a different experience,
Yeah.
and you got to be honest about
Sign
that.
here. Here's your money.
But
For me,
but what you have to do now is what I tell a lot of folks is this: we're going to ask you for a lot of stuff up front. We're not trying to make your life difficult, but it's the lesser of the evils. Because if we get all this stuff up front, if we get all the cards on the table, and we figure out all the things that could potentially go wrong, cover all those bases right now, when the stakes are higher, when you're further down the road, you won't run into those issues, and we've covered that. And then we remind them. And
I'm sorry. I was going to ask you a quick question on this. How much more difficult is it to get a home equity line of credit than it is?
it's a lot easier because home equity lines of credit do not fall under Dodd-Frank if they're open-ended. So in other words, if it's a line of credit and not a home equity loan, you're not dealing with any of the Dodd-Frank stuff.
Wait a minute. Home equity
Line of credit.
versus a home equity
Loan, like
which
a
is-
second mortgage.
A second mortgage is
right,
fully amortized.
right, fully
Gotcha.
amortized
Okay,
at
line of
fixed
credit
rate or whatever.
versus-
Yeah. So
Interesting, okay.
and we see that even what's so funny about it is you have, let's say on a purchase loan, I do a lot of piggyback financing, which 10% down on a jumbo loan, for example. So the 80% first mortgage piece is subject to Dodd-Frank, and the 10% second is not. Same darn transaction.
Wow.
So
Yeah.
try explaining that to your client, because they.
Explain an open-ended loan versus.
Well, so
one
it's
that's not.
simply put, an open-ended loan, like a home equity line of credit, basically works like a credit card. So you're going to get a line. Let's say it's $100,000, but you don't have to draw $100,000 on it. You could have a $25,000 balance on a $100,000 line,
You go in and out.
and you go in and out of it. Exactly. Whereas a loan would just be $100K. Boom, you get your
Yeah,
money.
and every time
closing, and
you start to make extra principal payments, you can't get that back.
you can't get that back. That's
Yeah.
right. So home equity lines of credit are very flexible. But what we see now with all of these, you talk about how do you counsel them? When you go into the process, you have a window of opportunity to lay everything out and say, guys, this is what you're dealing with. If you don't tell me something, I'm going to find out, right? And when I find out, I'm going to come to you and ask, and it's going to be harder to unwind it. And you just try and give them a lay of the land and say, this is the way the process works these days. I'm working for you. Here's what we need to do to see to a successful close that doesn't have any hiccups. And you know what? If you have that communication, I think where people get derailed on that is they, for whatever reason, they don't ask those questions or they shop a different way. They're focused on the wrong things, and then all of a sudden there's just a lack of communication, and something comes up that should have been known early.
Now, again, I'm a little shocked by that 49-day average time to close from that recent survey from December.
Because most of those contracts were written for 30 days.
Right. So,
Yeah.
I'm curious, Rob, how long do you know what your average is, or do you know about how long your typical transaction that you handle takes?
We're offering right now, and our company has invested a lot of time and energy in a 25-day guarantee close.
That's what I thought. I
Wow.
thought you guys
Yeah.
had a really aggressive
25-day
program.
guarantee close. So what we're doing on those, if you're looking to buy a house, you get pre-approved with us. We're going to fully underwrite the loan. It's going to be subject to an appraisal once you go into contract.
But you obviously have to get the borrower's information.
Oh, absolutely. We have everything.
There's a whole list of stuff
We
that
have-
people have to give you. And then
It's a
the
fully
officer-
documented loan. We've fully underwritten the loan, and all we're waiting for is you to get into contract
Gotcha.
and get an appraisal done, and then you're going to be done in 25 days.
So is this the same as pre-qualifying, as many people believe pre-qualifying is, or are you taking an extra
Yeah,
step?
pre-qualifying on steroids. It's a fully approved loan basically. You used to not be able to fully approve a loan until you had an appraisal and a contract. The purchase market that we're in right now demands that you're able to get a full degree of underwriting scrutiny, and then once you have those two things, you can go out. So basically, I've got the approval already. I know your income, your assets, and your credit.
Yeah, I mean, it makes sense because whether it comes before the transaction or after, I mean, obviously if someone's trying to buy a house that they can't afford, that's one thing. But
But
you're approving as to a specific dollar amount.
Correct.
So-
but it's resource heavy on the bank side. That's already very burdened by regulation.
Okay.
So if you do 10 of these, how many are going to close?
Well, that's the thing is how, I mean, and you can't charge that ahead of time.
You're not charging for anything.
Charging for
Yeah,
anything, so it's,
right.
there's no risk except for time and energy that a borrower puts
Well,
in.
and the residential mortgage market, Mark, as you know, is it's highly subject to interest rates. So you could have your underwriters tied up doing TBD purchases. What we're talking about here, to be determined purchases that'll
Okay
never
with that.
close. Where all of a sudden you've got an influx of refinances this week. Now where do you allocate your resources? Because a bank is in business to make loans that are going to close.
Gotcha.
Well, that's
So-
outstanding. 25 days
Yeah, it's a
guaranteed
good-
close. Rob
amazing.
It's a
Spinoza,
great program.
RPM Mortgage,
Great program.
definitely give him a call.
Yep.
That's
Happy
almost
to
as good as your 3-day close.
We can't do that. I'm out. That was me
But
folding.
mine
That
is
was
much
it.
more expensive.
That's
I
true.
can do it,
That's
but
true.
unfortunately it'll cost.
All right, guys, we're going to cut out for today. First of all, we want to make a quick mention to our friends at PAC Trade, Pacific Trade Exchange, business-to-business barter. Check them out, pacifictradeexchange.com. They'll give you all the information. Here's our thoughts for the day. The microwave was invented after a researcher walked by a radar tube and a chocolate bar melted in his pocket.
I
Think
heard
about
about
right?
that. Yeah.
And it's funny. I saw this little comic strip. It said, "I got 75% right on my math test." His mom says, "Hey, that's great." And he says, "Yeah, I should be happy, but I keep wondering about what happened to the other 35% I got wrong." Okay, and in Paraguay, dueling is legal as long as both parties are registered blood donors. That's a little scary.
Wow.
Tune in next week to The Best of Investing. Why? Because we're going to be giving away more free vacation. We're also going to be answering some trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown, wishing you the best of investing. So long.
We wish to have a duel. All right, let me see your blood. Let me see your donor
Yeah,
cards.
that's-
Donor
yeah, how's
card,
that
yeah.
going to work?
Do you have a donor card?
Yeah.
Yeah.
Can I challenge